Hi, everybody. Welcome to the third quarter of this incredibly crazy 2020 year. Who would have thunk we would be here about mid-January? I think late January, we're starting to get little clues, but I'm here with the amazing Vice President Apollo Lupescu from Dimensional Fund Advisors, otherwise known as the Director of Explaining Stuff. I think it's Director. Is that?
I don't know. It's something like that. Whoever came up with that.
But I must say, backed by popular demand, we've had so many positive comments from clients. Lauren, in particular, really seemed to like you and thought you were doing a great job at explaining everything. So anyway, it's been a while. Last time, I think we were in the midst or maybe coming out of the COVID crisis. And we came to Apollo to try to calm down everybody, get them to stay in their seat, stay in their saddle, I'd like to say. And I hope those who did so are happy that they did. We're not all the way back for at least the globally diversified small value tilted portfolio, but we're getting closer every day. But a component of all your portfolios is that US large cap close to S&P type stocks, and those have come back nicely. But we don't want to be in one asset class. If we wanted to be in that, we would have been in that asset class 20 years ago when we started IFA. The whole idea is to diversify across the world, across factors, if you will, small value, profitability, and get you a diversified portfolio. So sometimes different components of that do better than other components. And these are some of the topics that Apollo and I want to discuss with you today. But I first want to welcome all 71 of you now who have signed in. And let's turn it over to Apollo and hear some of his thoughts about this most recent third quarter of 2020. Hey, Apollo.
Well, hi, Mark. Well, it's great to see you. And by the way, I feel like I've never been to your house, but I feel like I'm being welcomed there because I recognize it now, and I feel not at home.
Come on down. We'll have to do that.
Thanks for having us back, and thanks to everyone for taking the time. And it has been a crazy year. I mean, I was just remarking with some friends how many things got piled up in just short 9 months. If you had, this is like a lifetime of events, and it's not even over. In 3 weeks we got another big one coming up that everybody's talking, the election, and I just heard yesterday that 1 million Californians already voted. This is 3 weeks before the election. 1 million people already voted in California, which is insane. In a way, it's great because it is civic engagement, and the fact that people are participating is fantastic, and so early. And anyway, so I don't know if we have a chance to talk about that, but let's start with the investment piece.
Yeah, please. But we're going to talk about the elections after we talk about the quarter.
All right, so let's talk about that. But as we go into this quarter, I think that perhaps what it might be worth starting with is one of the most ubiquitous questions out there. How did the market do? Because quite often you meet somebody on the street or you ask Mark, hey, or somebody at IFA, hey, how did the market do? And I think it's a really important question to start because we found this year and this quarter that answering this pretty simple question is actually more complicated than one might think. And that's why I want to take the time, because you quite often hear, how did the market do? And it's a little more complicated. So why don't we take a minute and unpack that and see, what do we mean by the market? Because we know what the stock market is.
Great question. I love that.
So the stock market.
We deal with that a lot, but go ahead.
Yeah, so,
yes.
But it's exactly right. What is the market? Because we know that buying stocks allows all of us, you, Mark, and I, and everybody in society to have ownership, to have a piece of a company, and that ownership allows us to have a stake in capitalism. And I think it's a phenomenal thing that we can all have.
I
And
love
some
that.
companies go from being relatively small, private companies, at some point opening up ownership to everybody in society, and that's called a publicly traded stock. And that's what we're talking about here. And these stocks trade on the market. So when you go to the stock market, you can trade with somebody else, not the company itself, but some other market participants. And if you want to buy, there has to be a seller on the other side. And that allows us to exchange these shares of ownerships and not necessarily wait for all this time for these profits to flow in for years and years to come. And it's a fundamental premise on the way that company raise capital, and it's a fundamental way in which us as individuals in the United States and around the world can participate in free markets. So it's a really important exercise.
Can I add one thing to that, Apollo? And I apologize for interrupting.
Not at
I
all. I
wasn't sure
love
you were
having a
gonna go there.
conversation, by the way.
So the other beautiful thing about the market is it helps us establish a fair price for these securities so that investors are positioned to get a fair return for the risk they take.
Yep.
I love that line from one of Marlena's papers where she said the job of a free market is to set prices so investors will be rewarded or are positioned to be rewarded, not will, for the risk they bear, something
Yep.
like that. And
Yep.
so that is another huge reason we have these markets. It's to do price discovery.
Exactly. And that price discovery that you're talking about is a fundamental, it's a fundamental premise of a capitalist society, as opposed to a social or communist society where the government decides what prices they should be. Whereas the free markets, these buyers and sellers are basically putting all these expectations and knowledge into this hopper that ultimately creates a fair value. Because let
Yes.
me make one thing clear. There's no way, in my view, that anybody knows the right price for any stock, because that correct knowledge would mean that if I pay some money today in the market, I have good knowledge of what am I going to get paid next year and the year after and the year after, and for 30, 40, 50, almost 100 years. Exxon has been paying back shareholders for over 100 years. So correct pricing means that I need to know what am I going to get paid for 100 years. Frankly, I don't think the CEOs of those companies know. How are you looking at market? Nobody really knows. But what the market does, it takes all these expectations and forecasts, put them together, and it creates this beautiful thing that at the moment tells you what's the fair value, not the right value, but what's a fair value. And I think it's really important to know, because if you don't believe that, then you're basically betting your opinion against the combined wisdom of everybody else in the market. So with that being said, right now in the U.S. market, the way that I think Mark and I share that philosophy, we look at this the stock market in the U.S. as being about 3,511 companies that have opened up their ownership to the public at large. And these are called tradable stocks. So whether you look at Nasdaq, New York Stock Exchange, American Track, there are all these different, there are about 14 different exchanges or so that you can buy these stocks. That's what the stock market is to us. It's this comprehensive look at all the stocks that can be bought and sold.
Yeah.
Now, every company has a bigger or smaller economic impact. Has meaning. In other words, they're larger or smaller. And what we consider large is the world called this world called capitalization. And what it means is that when you look at the value of all the shares of ownership and how much each one of them cost, you get a sense of how much would you need to pay to buy the entire company. That's the overall value. If you pay that, you would get the entire company. So you have to know the number of shares and how much each share is worth it. And the companies that have a larger value, they tend to represent a greater percentage of this overall market. So not all companies are equally weighted. So some companies, the larger ones, would have a greater percentage allocation to them. And in this case, the largest stocks in the US, we all know these companies. Apple, it's close to $2 trillion. You had Microsoft, Amazon, Google, and Facebook. When you look at combined, the five of them, Those are the largest stocks in the U.S., and they do represent a larger percentage than other companies that might be in this 3,500 or so stocks. The smaller they are, the smaller the percentage. So it's kind of like, what's the economic, how meaningful from an economic perspective is that company? And that's what you're trying to reflect. So it's not just that you have 3,000 of them, but how much emphasis do you put into one of them? This type of constructing a market is called a capitalization index, a market cap index, which means that the market capitalization, the value of each company, is reflected in the percentage that you see out there in the market relative to other companies.
Right.
That's what market is to us.
Yep.
Now, when you turn on the radio, when you look on TV, when on the internet, probably the most widely used metric is the Dow Jones Industrial. Dow Jones, everybody knows Dow Jones, and that's how often we cite how the market, not we cite, but talking about in general, the public, how any investors might discuss how the market do by reflecting on what they heard on the news about the Dow. So what is the Dow? It's the longest running way of measuring the market, going back to the 1880s, when Charles Dow established it. Initially, it had 12 different companies, but today it has 30 companies. So the Dow Jones has 30 companies out of the 3,000 that exist in the U.S. market. So certainly, it's a pretty low number of stocks. And together, the value of these companies amount to about 26% of the value of all stocks in the market. So what's interesting is that, think about that measure. It's pretty shallow. We're looking at 30 companies to reflect on how 3,000 plus did. And the value of these companies is about a quarter of the value of all stocks in the market. So certainly not a very broad measure. It's a shallow measure. It is the oldest, and probably that's why it's still being used, but professionals don't really use it because it is so shallow. Not only that, but the Dow has one more thing that makes it a fairly inefficient way to look at the market. What the Dow is looking at is not the value of the company as a whole, but rather what is the value of each share? What's the price of each share? And to really understand the difference, think about this. You can have a very large pizza pie that you cut into a large number of slices, or you can have a much smaller pizza pie that's only cut in two. Well, what matters more, the size of the pizza pie as a whole, or the size of each slice? It turns out that the companies themselves decide how small do I want to cut the slice. So the price per share is almost insignificant. A few weeks ago, Apple had an event where they basically said, we're going to cut our slice into smaller pieces. It didn't change the value of the size of the pie. It just simply had more slices. Well, at that point, the Dow Jones actually cut its percentage way down. And Apple, what used to be towards the top, it's no longer towards the top. So what are the biggest holdings in the Dow that are supposed to represent the U.S. market? The largest one, United Health Group. We all know United Health, but it's not like you don't go out there and say every day I run into United Health. The Home Depot, certainly known, Microsoft, McDonald's, and Visa. What's interesting is that Amazon, Facebook, and Google, Alphabet, they are not part of the Dow. And Apple is in the bottom half after they cut their slices into smaller pieces. Yeah. So how can we possibly consider a metric of how the market did without having 3 out of the 5 largest companies as part of that metric, and the largest one being somewhere down to the bottom? It's a very shallow metric, and yet it resisted. I mean, a lot of people still reflect on the Dow and how the market did when it is not the best way to look at it. And I think it's important. Most people, I find, they don't really realize the limitations of the way the Dow measures the market. So that's the most popular way. Now, Mark, not that you do, but when typically people look on the news after the Dow, what's the next one that everybody looks at?
It's Nasdaq.
Nasdaq, exactly right. Nasdaq. What is Nasdaq? Nasdaq is a way of looking at all the stocks that have chosen to trade on that exchange. you can trade to whatever exchange you want, but these companies have chosen to trade there. And right now, in that particular way of looking at the market, there are about 2,000 stocks, so certainly a lot more than in the Dow. The thing is that some of them are US, some of them are international. But what's also interesting is that a lot of the large companies that are in the US market chose not to trade on Nasdaq, but they might trade in New York Stock Exchange or some other one. And because they're not listed on Nasdaq, they are not part of this group of stocks. And because of that, Nasdaq represents less than half of the value of all companies in the US. So it has a large number, but so many out there, tiny ones, the small companies that don't amount to much. And that's why Nasdaq is only about half. Now, Nasdaq, similar to what we talked earlier, it is a market cap based index. So the value of the company as a whole, the value of the size of the pizza pie matters the most. And in that respect, you do see these largest companies as being on top because they all actually trade on Nasdaq. But what's fascinating is to see how concentrated the Nasdaq index is. When you look at Nasdaq, 41% of the value of Nasdaq comes from 5 companies. 5 stocks amount to 41%, which is a remarkable concentration in just a handful of stocks. So, is Nasdaq representing the market? Yes, Mark.
And it's even worse because a lot of people buy that Nasdaq 100 to get Nasdaq exposure. And now instead of 2,763 stocks, you got 100. And you probably don't have the data here, but this 41% might go to what? I don't know, 60 something?
Whatever. I won't even speculate, but you get the picture.
It
you only have 100.
Higher.
Yeah. Right.
The other thing, there are a couple, before you get to your next one, I just wanted to reflect on a couple things. It wasn't too long ago, maybe 10, 15 years ago, that we had 5,000 stocks instead of 3,500. It was where the Wilshire 5,000 name came from.
Right.
Now this is more reflective of the Russell 3000. We're getting closer to that. But it is interesting to note that we've had, 1,500 stocks or so that have basically gone away through either delisting, mergers, or just failure of the companies, whatever it might be. And so we do have a little more concentration in our US markets. The final point I want to make is we do have a lot of clients who call us and say, I really love that Apple stock. I'd like to buy some Apple. And I tell them, you have Apple. It's 5% of your US large cap holding. Why would you buy more? Why would you overweight Apple beyond the allocation, that we've carefully constructed for you? And in fact, I like to tell people I love all stocks. We have 13,000 of them across the board. And so, you don't need to really pick one that you think is maybe mispriced or underpriced. Anyway. So those are a couple observations. So I didn't see the S&P 500 in there.
Right, it's coming up. It's coming up, but that's a great point. That's a great point that he made. And we'll come back to this because perhaps we should touch on this. If Apple has done so well and you know the company, use the products, why not invest more in it? Because I think that some people are saying, I know we had it, but why didn't we have more of it? And perhaps it's worth addressing it. So let's talk about the third one, the third leg of the stool, which is, the third way to consider, not leg of the stool, but the third way to consider the market, which is what professionals tend to use. And I know that Mark and I quite often you see it on our websites. It's the S&P 500. And in this case, the stock exchange on which the company trades is irrelevant. So in that case, it's more comprehensive because these are largest 500 companies, and it does amount to about 84% of the value of all stocks. And even though it doesn't have as many as Nasdaq, it only says 500 because it includes a lot of the large stocks that are not part of Nasdaq. They trade on New York Stock Exchange or others. It is more comprehensive. So that's why you see that you have more coverage of the market through the S&P. Now, they tend to be only the large companies, the largest 500 companies, but also to make it clear, not all of them. S&P is a pretty tricky little thing because there's a committee making decisions on what companies to go in there. And just because a company is large, it doesn't mean that it's included. And I think the shining example of that right now is Tesla. As large as Tesla is not part of the S&P. The S&P committee has decided not to add it in, even though the criteria has been met. They just chose twice so far to just say, no, we don't want Tesla there. Now for Nasdaq, Tesla is actually the sixth largest, if I remember correctly, holding, and Tesla has done remarkably well. So it is in Nasdaq, but it's not in the S&P. So it adds even more confusion, and certainly not in the Dow. But to me, it's a really important thing. And by the way, the same as the market and Nasdaq, the S&P is a market cap based index when they do consider the size of the company and the way they weight each stock. And in this case, when you look at the largest 5 companies, they amount to about 24%, which even in the S&P, it is quite a bit. In the overall market, it's less. It's about 19%, but in the S&P is even more. So that's how we consider the market. So what is the market? I would argue that the way that Mark looks at it, the way that we're looking at it, is a much more representative way of saying, well, how did the market do? But it also comes with one other thing. This is not the market, because when we think about the market, this is the U.S., which is a big part of the global opportunity set, but there are certainly companies and countries abroad in which you can participate as an investor. And when you really put it in a global perspective, what you see is that from a global perspective, instead of 5,000 or 3,000 stocks, you have over 14,000 different companies, US and global, in which you can invest. And that is a true global opportunity set. That is a true global opportunity set. And from that perspective, if you are invested and diversified globally, then certainly it makes it harder for you to compare yourself with a little subset of the Dow Jones, which is only 15% of the value. How can you take 30 companies in the Dow and say, well, how did my portfolio do, and compare with the 14,000 that you had? That's really important to know, that there will be differences. You do have the Dow stocks, but they're part of a much broader perspective. You have the Nasdaq stocks, but they're part of a much broader perspective. And this is really important, particularly at this moment in time. And let me tell you why this is so important at this moment in time. It is important because if you look through the end of September, so not for the quarter, but year to date, the S&P 500, the U.S. market, has done actually quite well given the pandemic and everything else that's going on in the world. And you might look and say, that's great. That's fantastic. That's so good to hear. Now, let's break it down a little bit. When you look at the S&P 500, the largest 5 companies, the Apple, Amazon, Microsoft, Alphabet, and Facebook, on average, through that first 9 months of the year, they had a whopping 40% return. That's why people are paying attention to these companies, because through this year, because of a variety of reasons, they are up 40%. Is that unreasonable? Well, you know what? It's not like we don't know who these companies are and we don't use them every single day. I mean, I know there's a box coming every day. I don't know who's buying in my house and why is it, but I know it's coming sometimes twice a day. I mean, there are Amazon trucks going up and down the street every day. We all use Apple products and Microsoft. We're using it right now, Google. So we do know that these companies are making money and they're being used more and more. So they have done tremendously well. Now, what about the rest of the 495 different companies that are in the S&P? Well, when you average them out, what you see is that on average, the rest of them lost about 5% for the year. So in other words, it's a story it's a tale of 2 groups of companies. The large 5 stocks have crushed it. They've done tremendously well, and that's phenomenal. But not necessarily the rest of the market. And why is that relevant for the discussion at hand? Because if you look at this global perspective that we had on stocks, so and you look at these companies, the 5 stocks and Tesla, they have done tremendously well, and they are 41% of Nasdaq. So if you put so much money into, you happen to have put so much money into these 5 stocks that have done tremendously well, this guy here is going to look like a superstar. Nasdaq is going to look like a superstar because they were so concentrated into these 5 stocks. The next one probably will be, if you look at performance, is likely to be, so if this is the top, if this is one, probably the second one would be the S&P because it has a quarter of the money in those stocks. The third one among the popular ones is probably going to be Nasdaq, Dow Jones, because it doesn't have 3 out of the 5, and the ones that does have them, like Apple, is towards the bottom half. So you can see that on the news, if you look every single day, there will be a discrepancy. There'll be a disparity between how the Dow, the S&P, and the Nasdaq do. And when these 5 tech companies do really well, Nasdaq shines. When they do poorly, it's going to tank. And that's what we're seeing, is that every day there is a difference performance on the news. Pay attention, and you'll see that Nasdaq does one thing, the Dow did another thing, the S&P did another thing, because of the way they're constructed. And last but not least, to the point that Mark made earlier, you did not miss out on these 5 stocks. They were part of a global allocation. They were part of this global portfolio. It's just that because we're so diversified, they're only 11%. So if you're going to look and see how did the globally diversified portfolio do relative to Nasdaq, well, I know it's not going to do as well because it's not so concentrated in these 5 stocks that happen to have had a tremendous year. So it's a lot about managing expectations and realizing, why is my portfolio behaving differently? Not that you're missing out on anything. It's just that it's more diversified. And at this particular moment in time, you had these high flyers, but you also are diversified because one of the things that I'm going to come back over and over, you need to be diversified. You cannot capture the next Amazon by being invested only in Amazon. you need to go outside of these large stocks that have done so tremendously well. So
that's what I was about to ask you, Apollo. Can you tell me which 5 stocks will be earning 40% next year?
Well, it's funny I said that, because at the beginning of this year, if you had asked people what were the top 5 stocks, very few people would have chosen the ones that they did. I mean, you look at Tesla as an example. Tesla has been flying high, and at the end of last year, one of the tax incentives that kept sales up to some degree was taken away, and then that was removed, and yet it didn't seem to matter. So at the end of the year, I remember talking to people. I'm not in the business of looking and watching individual stocks, but I do remember reading how people were saying, Tesla can't do that well because they're not going to have that tax.
That's right.
Who would have known that Exxon, over the course of this year, even though it is an industry that it is out there, that the administration is interested in helping the fossil fuel industry, it's lost half its value. Nobody could have predicted that some of these things would happen, and you know why? Because there are some things that we expect, and those are priced in, but some unexpected things come up. And those move the prices as well as they happen. And that's what happened with the pandemic. That you can't say you couldn't see the pandemic.
Apollo, I just got to jump in here and share this, because I'm sure people say, hey, I knew those stocks were going to be the winner this year. I just love that Apple. I love that Facebook, blah, blah, blah. And so, I can pick these stocks. I love this study from Standard & Poor's where they looked at this persistence of outperformance. In other words, they looked at 938 large cap fund managers whose job it is to pick those winning stocks so they can do better than just buying the S&P 500.
Right.
In the first 3 years, only 99 of the 938 did better than the benchmark. But the real killer in this is you got a 10% chance of picking the winners. Not good, but at least there's a chance. But if you follow those 99 for the next 3 years, 0. continue to outperform. So if you think it's so obvious that these stocks will continue to be the winner, you better think again, and you must be new to picking stocks, because this data, we've been talking about it for 21 years, is overwhelming that this is a fool's errand, and let it go if you think that's something you're good at. Granted, some people get lucky, but what this really tells you is this great academic phrase that I love, which is luck does not persist.
Yeah. That's funny.
Sorry, just had to get that in there.
No, I think you're absolutely right. And the only thing that I would add is one more comment, which is that when people look at these companies and we see ourselves using them, and we like the products and we like what they do, it seems like they connect with us. It makes us believe that what can go wrong, that these companies will be the large dominant stocks of the future. So why not be part of the future, as they will stay large and dominant? And that's a fair question. Could a company like Apple, Microsoft, Google, Facebook, could they be large and dominant for years to come? And for that, we actually did look, and we had a really interesting study that we did, and we looked at the companies across time that get to that point where they become just large. Exactly right. So, but
I'll let you describe this chart.
Well, actually, let me share one thing before that, because I think it's actually quite interesting before we even get there to share. So what it is that we have good data on the U.S. stock market going back in the 20s.
Yep.
So the mid 20s. So if you look at the companies going back to 1930, and you want to know what are the companies that are large and dominant, and more so, Mark, do they stay large and dominant? That's an important question. They stay large and dominant. And when we did this, we actually ran that exercise, and this is what we found, is that if you go back to the 1930s and you look at companies that get to be in that club of top 10, these are the largest top 10 stocks in the market at the beginning of each decade, what you see is that some companies that are in gray, they're only there for a decade, like a Time Warner or a Bell South or Mobile or Altria, the cigarette maker. So it's possible that some of these companies might not be there for a very long time. And once they crack the club, they just can't really hang in there for that long. It's possible. But it's also very obvious that if there's a color, that means that they are there for multiple decades. And what's remarkable is, take, for example, AT&T. AT&T was the tech stock of its time. Telephony was a big deal. So it was a technology stock of the 1930s, and it was the largest company for 4 decades until 1960s. And then for another 3 decades was in the top 4. We're talking about 70 years of dominance and being one of the top 4 companies in the market. So it could last a long time. Exxon was the top 5 in the 1930s, and it became the largest 10 years ago. 90 years of being there. General Electric, the same. There was technology of the time. So it is quite possible that once a company gets to be this large and dominant, it stays that way. So if you're asking me, could Apple, Microsoft, Google, Facebook, Amazon, could they continue to be the large dominant companies of the future? I wouldn't be surprised if they were. I wouldn't be surprised. There is plenty of evidence that once you get there, it's kind of hard to take down the incumbent in some way. You look at this time frame, just visually.
Yep.
Basically, most of the companies who are in the top 10, they tend to stay there. So I wouldn't, if somebody were to ask me, what do you think about that? I'd say it's possible. It's absolutely possible. I can't discount the fact that some of these large tech stocks of today might continue to do to be dominant. Now, the question though is a little bit different, and this is what's important to distinguish.
Yep.
The question shouldn't be, will these companies continue to be large and dominant? I think a better question, will they also be great investments? And that's a different story.
Yep.
So we want to know not whether or not they're going to be large and dominant, but will they be great investments? And for that, that's what Mark just showed you. If you go back and you take, this is the time when they get to be in the top 10 club. And you see, how do they do before they got there? Before they got to be as big as they are, before they are the giants of today. Well, if you look back 10 years, on average over the previous 10 years, they outperformed the market by 10%. This is the level of outperformance relative to the market. So let's just say that the market was 10%, just to make it easy. There was a return on the market. Over 10 years, they returned about 20% per year, which is a huge number. It's a remarkable performance. Over 3 years, they performed 10%, 24.3% better than the market. So over 3 years, they had a return of about 34.3%. If you think the market return is 10%. So
Right.
On the way to becoming a large dominant companies, these had tremendous performance. And because of this increasing price, it allowed them to be a top 10 stock. The question is, once you climbed the mountain, you're on top of the mountain, how does it look afterwards? What is the experience of an investor for these companies going back to the 30s? And what you see is that over the short run, over 3 years, they do tend to outperform the market, but by a lot less. And once you get to 5 and 10 years, they actually underperform the market as a whole. So what's incredible is that, again, it's like you're climbing a mountain, you got to the top, that's great. But from there, it didn't seem that they can sustain the same performance. They're running out of steam. And in fact, it's unlikely, because if they continue at the same clip, at the same pace of growth as they had over the past 10 years, they would just become like half the stock market probably. So it is interesting to see that the performance happened on the way to getting as large as they are, but it doesn't really sustain afterwards. And intuitively, why might that be the case? If you look at Microsoft or Apple or Facebook or Google, how easy is it for them to grow and double in size? Realistically, how easy is that? Probably not as easy as on the way up. And then more so, as they grow and they become large, mature companies, their cost of capital might be different, because they might now be large growth stocks. And we do know that large growth stocks, they do tend to have a lower expected return than the market as a whole. So in that respect, it's not necessarily surprising that when you look down the road, you don't see the same great performance. But it is important to know that the only way to get the next Apple, the next Google, the next Microsoft is to diversify. And that's why diversification is so important. Have these companies, but careful on how much you emphasize them, because history doesn't seem to show that they continue to outperform for a long time afterwards.
So, Apollo, can you put that back up again? Because I want to reemphasize one of the points you made about the price of these stocks. So one of the most difficult things I've found in talking to investors is that there's a real difficulty in appreciating that your returns are tied to the price you pay for your security. It's not about how good the iPhone is.
Right.
If the wonderful technology of the iPhone is already reflected in the price of the security, then you are too late. You had to buy it before the iPhone came out. You basically had to have inside information. And I like to say, before you trade on that, you better make sure an orange jumpsuit is a fashion statement for you. Right. But so the price is what's so critical. And just imagine, after those 5 stocks had earned 40% a year, and I'm holding them, Apollo comes to me and says, Mark, I really want to buy that Apple from you. And I'm going, well, geez, Apollo, it's had such great return. I hate to give up what I think are certain returns in the future unless you pay me a price that gives me some of those returns I'm foregoing today, right now. And once Apollo pays me that price, he doesn't get those returns because I already took them.
Right.
That's what the price is doing in investing. And I just cannot tell you how many times people read to me yesterday's news and somehow come to the conclusion that the market has not already priced in that information.
Right.
And if there's anything I can get across to all of you listening today and on future recordings, is investing is about the price. And you need to make the conclusion that the price is wrong, which was obtained by about 10 million people trading 10 billion shares every day.
Right.
How can you have that superpower? That's what I want to know.
I know.
Let's talk about the election. So
Election.
we have, God knows how many Republicans versus Democrats we have here today, but a lot of people are all kind of worked up about what this might mean for their investments once we have our election and going forward, maybe even for 4 years or so. So let's talk about that a little bit, Apollo.
So where should we start? Well, I mean, the place where I would start with the election is something that it might be obvious, but it's important to acknowledge, is that when we think of politics, it touches on our deeply held beliefs, our core values, and our identity as individuals. And because of that, it's a very emotional subject. And there's nothing wrong with feeling emotion around politics, because that's what makes us human. That's what human beings do. They have emotions. There's nothing wrong to feeling emotions around politics and the election time. Now, what is also interesting is to think about the times when he took action while you were in the middle of having an emotional episode. How did that work out? Because when I look at my own life, frankly, I don't think that I made the smartest decisions when they were heated with emotion.
That's TMI. That's TMI. Paulo, we don't want to get into all your decisions.
No, we're not going to get into it. But, emotions play a role, because, listen, the most important decision that I ever made, which is who to marry, it wasn't a bunch of spreadsheets. It was just an emotional, how did I feel at the time? But I'm talking about money.
I actually had one, but we're not going to go there.
You had a spreadsheet? I'm surprised it wasn't a database. So here's the deal. If you think of politics as being emotional, we want to acknowledge those emotions. At the same time, what I think it's important to do is disentangle these emotions from investment decisions, because there's so much evidence that behaviorally, these emotions don't always lead to decisions that are in our best interest. And because of that, while it's important to acknowledge them, and that's why you ought to talk to Mark and you ought to talk to the IFA team, if you have questions, if you feel unsettled about the election and what might be coming, realize that to a large degree, this is about the emotional side. Our job is to be more pragmatic. And I don't need to tell you that Mark, more than anybody else in the world, is not driven by anything else but pragmatic reasons, data and evidence and research. And I think that's important to know. And go ahead, Mark. I think it's a great piece.
Well, so speaking of data, you may have seen this on our website, and we published an article about this not too long ago. I was curious. We were starting to get lots of data about past elections and what that had to do with the market. And we were literally shocked. And now I have heard from 3 different sources, independent sources, one of which is Kenny, who's sitting there silently helping organize our program. He checked these numbers himself. He's our associate regional director at Dimensional. And then there was another advisor in the East Coast, actually the son of Ken French, who did the same study. And then I insisted that our own team do this analysis. And what we looked at is basically when the president, the Senate, and the House were all Republicans, and when they were all Democrats. And then we wanted to know what the returns were during this period. So what's nice about this is you get the full impact of all the Republican policies, the full impact of all the Democratic policies or Democrat policies. The only thing is one's 13 years and one's 34 years. So someone could question maybe those sample sizes. But the results were incredibly interesting. Don't know how profound or how forecasting they are, but they were 14.52% for both of them. And so one of the things that this drives home is this idea that whatever news is out there, this is Eugene Fama's Nobel Prize. The price reflects all known information and the forecasts. So even if there's something bad, depending on what perspective you're coming from, a price adjusts to it immediately. and then it positions you to get your fair return going forward. And as the result, the policies were probably impactful, like the good company and the bad company. The environment isn't the point. The point is what's the price? Can we price the news? Can we price these environments so investors are positioned to get their fair returns? So this is incredible information that these were basically the same. Now, the other thing, and this came from a dimensional study, as you see down here. Actually, maybe we replicated the study. During the election year, what does that look like over 90 years? Well, that has averaged out at 11.28. And then the year after has been 9.88. So neither of those should be a concern for investors.
Right.
So I would be more concerned about whatever policies you want to see the government have in place than you are your portfolio. And I think the other related point, and I think I've heard you mention this before, Apollo, there's a lot of other things that are going on other than who's president. Right. How about the internet? How about, planes, trains, automobiles?
Yeah.
A lot of other inventions, iPhones that come along that are not impacted by the president. So hang on to your portfolio, rebalance your portfolio, maybe glide path your portfolio, get a little safer over time, and don't come to the conclusion that markets somehow have mispriced your securities for a fair future return.
Right. I mean, to me, amazing. I mean, Mark, seeing those numbers, they are identical to the second decimal.
Yes, I know.
Like nuts to the second decimal. Like if it was 14.5, I'd say, but 14.452.
One of them was 14.5201, and the other one was 00. So,
okay. So well, which one? Because we're going to vote that way.
So I just, I've had a handful of clients. Maybe some of them are on here, who said, you know what, I cannot hold my portfolio if X is in the White House, whoever it is. And I hear it from both sides, by the way.
Right.
And then I show them this information and they're just kind of going, oh my God, now what do I do?
Right.
And some of them have elected to actually liquidate their portfolio against my advice, by the way. And, maybe it makes you sleep better at night. But I just like to remind people, we get returns because we bear risk, not because we're sleeping well at night and we want safe investments. Now, I want you to sleep well, but that's part of the risk, risk capacity survey, is to get you to that blend of stocks and bonds that's just right for you. But I don't want you to be market timers.
Yep.
So you had some other slides there, I thought. On
I just want to follow up on. I just want to follow up on some of the thoughts that he had, which is exactly right. I think that if somebody is looking and saying, "I'd like to sell my positions," again, you have to look and say, what's the analytic? What does the evidence say? What does it show? And if there's a strong case for that, perhaps so. But when you look at the evidence, it actually doesn't quite point in that direction. And let's start with just a big question. If we are in an election year, what is it that we should expect? And we have good data in the U.S. going back to 1926. And in these 94 years, we have 23 sample data points of election years and see what happens in an election year. Is the uncertainty somehow impact the market or not? And Mark just showed you that great point that among these 23 different elections, the average for these 23 years has been, if I remember well, 11.28, let's say 11.3% growth. So the market on average in an election year actually goes up by 11%. But this average that Mark showed you is basically maybe reflecting on some positive years when the market went up and maybe some negative years when the market went down. And I would invite all of you in the audience right now to try to come up with a number. What's the split between positive years in these 23 election years versus negative years when the market went down? When we ran that exercise, what we found is that remarkably, 19 out of the 23 years, the market returns were positive in an election year, and 4 out of the 23, the market went down. So it's interesting because the preponderance of the time, the market tends to go up in an election year, but not every time. And this is a little bit better than non-election years, but not vastly different. It's actually a little better, but not vastly different. So by and large, from everything that we look at, being in an election year or a non-election year, it doesn't seem to have much of a difference, make much of a difference for an investor. Now, let's kind of touch one more thing. These 4 years that the market went down, I thought if we examine those, are there any lessons that would help us learn something about the behavior of the markets in election years that would help us cope with this year's election? So if you take a look at the 4 times when the market went down, the first one that happens was in 1932, and that was FDR versus Hoover. The market went down. But remember, 1932 was also the worst year of the Great Depression. Yep. Yeah, we had an election, but we're also the Great Depression. 80 years later, in 1940, once again, an election with a negative outcome in the market that year. But that was the year when Germany invaded Europe, and it became obvious this would become a much bigger conflict. And it took 60 years in which the country was polarized. We had, civil movements, and we had a presidential candidate being shot and killed. But it wasn't until 2000 with Bush versus Gore when once again we had a market downturn in an election. And it's kind of tempted to think, wait a second, that was a contested election. Remember that gentleman in Florida looking through a little hole and Chads? I didn't even know what a Chad was until then. And it went a few weeks. It wasn't settled the night of. It took a few weeks to the Supreme Court, all the way to the Supreme Court. But eventually, as a country, we sorted it out and moved on. But could that have led to the market downturn in 2000? Well, it turns out that by the time the election came around, before the election came around, the market had already dropped. And why is that? Because that was the year when pets.com and all these high-flying tech stocks were starting to lose value. And there was the beginning of the dot-com bust. And the last one, obviously, in 2008 with the financial crisis. And here comes a big thesis that it's going to come up over and over and over again. And Mark touched on it. Politics and election is a variable when it comes to stock market performance and individual company performance, but it is not the variable. In every single case in an election year, when the market went down, there was something a lot bigger going on in the world that might have driven the market down. So yes, I can't say that election and politics is insignificant, but in the grand scheme of things, it is not the variable. It's one of the many variables. And in fact, I would dare to say is not a primary variable. It's actually a pretty minor one, as much as the media wants to make you believe that it's such an important factor. It's not, folks. It's not. It's not. The market is driven by so many other things, and I'm going to tell you why in a second. But it is not driven by the election or who is in the White House. If you go to 1969, the year that I was born, and you look at who was in the White House and how the market did, and you start with President Nixon. When I was born, for 5 years or so, when he was in office, the market actually dropped an average of almost 3%, 2.9%. And then President Ford comes along for 2 years or so, market skyrockets. And then if you fast forward through the different presidents and the average annualized return during their time in office, the one thing that becomes pretty clear is that there is no obvious pattern that would tell you that having a Republican or a Democrat is better or worse for the market. There's no way you can say that. It's just, you can't do that. It's not only that, but I would say that a president should receive neither credit nor blame for what the market did. We talked about President Nixon. Well, at the time, we're going through the transition from the gold standard to the current currency we have, which is that process started before he even was in the office. Then the crisis in the Middle East happened, and the 73, 74 result of the OPEC oil embargo. Should he receive blame for that? You look at the other president with negative returns, George W. Bush, President Bush. He walked in just as the dot-com was about to go bust. 9/11 happened 9 months into his term, and he walked off at the very bottom of the financial crisis. Should you receive blame for that? I don't know. I don't think so. On the other hand, President Clinton happened to be there when these tech giants were formed and took off. And talking about market timing, left before they actually dropped. So to me, the premise is not that one president is better than another. It's just that there, it doesn't. A president should receive neither credit nor blame, because there are much bigger factors that might drive the market performance rather than who is in the White House. And we can look at it in a variety of ways. And I'll touch on two, Mark, if you allow me, on that I found really interesting, that I'm getting from clients. Some of those clients that you mentioned, that they are a little bit perhaps concerned with the market and what's going to do, and they say, I'm going to sell. Part of the reasons that I hear out there is that they're afraid of taxes. If tax changes happen, what could that possibly do to the economy and the market? And I think that a lot of folks are concerned about that, and they do believe dearly that tax cuts are a recipe for market growth and economic growth. And there's plenty of economic evidence that tax cuts could help the economy in the right context. When it comes to the market, it's let's look at some data, and these are anecdotal data, but I think they do tell a story. If you look at two presidents really well known for their tax cuts, and I'm going to take President Reagan. President Reagan actually is really well known for the tax cuts that he had to the income rates, and the market did well. The market did really well. $1 invested at the beginning of his presidency would have more than tripled by the time he left office 8 years later. Not bad. $1 turns into $3.24, more than triples in 8 years during his presidency. So certainly a good growth in the market during those days. Now, the other president, really well known more recently, is President George W. Bush. Not one, but two rounds of tax cuts, and some specifically two investments, capital gains and dividends. And yet $1 invested at the beginning of his presidency, by the time he left 8 years later, it would have turned into 70 cents. So to me, tax cuts are no guarantee that you're going to have successful returns. There are a lot of other things happening in the market that would drive it rather than the tax cuts. So again, there's no obvious answer to say tax policy. President Clinton actually had tax increases, and yet the market did better than even President Reagan. So I wouldn't go that far. But it's the more fundamental piece here, Mark. Up until a few years ago, tax rates were higher for companies. Is there evidence that the companies couldn't function and the market tanked? Not at all. What companies did, they figured it out. They figure out if it makes sense to create a subsidiary in other parts of the world and to transfer price some assets there. They figured it out. And if tax changes happen, they'll figure it out again. Individuals the same way. That's where a lot of the products, and even when you go back to the 90s, the question was, what can we do to mitigate taxes? And there is a set of tax managed solutions, and there are things that he can do to manage in a very legal way, both at the advisor side and the investment managers. So if taxes change, it's nothing new. It's nothing that companies are going to go on. It's they'll figure it out. But more so, people are sometimes afraid that if we go from a perceived business friendly environment to something that is perceived to be more, let's say, social program oriented, that won't be good for their money. I think a good example of that is I still remember a cover from Newsweek from about 2009 or so, when it called the world socialist now, because we had a president who was much more interested in social programs, and in fact President Barack Obama is mostly known for Obamacare and helping, people with healthcare. So certainly not known for the business side. And what's incredible is that $1 invested at the beginning of his presidency, by the time he left, it would have tripled to $3.28, which is remarkably similar to the Reagan years. So whether you look at President Reagan with all the tax cuts, or you look at Obama with Obamacare, market response was virtually identical. Again, it's less to do with presidents. I think we're trying to find an easy explanation of what drives the market. It's much more complicated, and the reason that's much more complicated and it's not tied as much as people believe is because when we buy ownership, we buy profits. These profits are likely to be driven more by the company's products, by the strategy, how they executed, what competitors do, what's going on in the world, more so than who's in the White House. And again, the fundamental premise, Mark, that we talked about, free markets and capitalism.
Yeah.
In free markets, companies will find a way to make money irrespective of the state of the world. I don't believe that these companies are going to say, oh, I'm not going to worry about making money because there's a new president. They're going to figure it out. What do you think? And particularly global perspective, is a family in India buying tires, is that decision impacted by who's in the White House? Are you and I going to eat fewer blueberries because we disagree politically with some of the things? No, we're going to keep carrying on, and that's the idea. The idea is that markets are resilient because companies are resilient, and companies are resilient because people are resilient, and that hasn't changed.
Yep.
That's what's not different, and that's why I don't believe that even if we have a new administration, and let's say we don't even know, but let's say the taxes do go up a bit, is that going to be devastating? Not at all. Not at all. We've seen times like this. Anyway, so it was a long-winded monologue, but I feel pretty passionate about letting people know that it does not matter to your money. If it's President Trump or President Biden in January, it does not matter, because the market is driven by a lot of other things. And even if you think the last few years that tax cuts have been lowered, you have a lot of evidence from companies saying the trade wars and tariffs have taken a toll on their businesses. And nobody should feel pity from me, but I've been trying to buy a surfboard for my daughter, and everything's out of stock for months. Yeah, I mean, I'm a middle-aged life crisis kind of guy, and I'm trying to buy dumbbells and a bike. Forget about it. Everything's out of stock. And that has to do with
You were too slow, Apollo.
I'm sorry?
You were too slow. Hey,
okay.
Listen, I've got another question. We've kind of gone over our time a little bit, but it's so.
Oh, I thought he was 1:30. Sorry, I didn't realize that he was.
Let's go to 1:30. I can do this.
Oh no, we don't need to go. I just remember seeing in the calendar invite. So maybe the last half hour is just the two of us kind of bantering. But
no. Let's keep going. Listen, I could do this all day with you.
It's fun. Me too.
So listen, we had also a question that said, with all this uncertainty, maybe I should get some more gold in my portfolio. Somebody already had, what did they say, 5% gold. With all the tumultuous markets, should gold or other precious metals hold a higher portion of our investment portfolio? The answer is no. Here's why I don't like gold and precious metals. If we were to look at the last 42 years of risk and return data of a bunch of asset classes, here sits your gold. And all it would have done was increase the volatility of your portfolio. Let's say you had a portfolio 70 and we added gold. You drag your portfolio 70 down here, and look at this gold return. It actually has been less than owning a 1-year bond fund, where you could have done that with a standard deviation of about 1.5 or 2, whatever that is, versus about 19 standard deviation. That's the volatility of the price, owning that gold. And then look at silver. Oh my gosh, 2% return for 42 years at a risk of about 32. These are the least likely investments to improve the performance of your portfolio. So the answer is forget about that gold. Listen, it's a simple thing you have to remember about commodities is what Apollo said earlier, the price of a stock is dependent on the earnings. You're basically getting a return because companies make a profit. Does gold make a profit in and of itself? No. The same bar of gold from 1620 is the same bar of gold today. It has an increased value, but it's mostly an inflationary type increase in value. It's not because the gold multiplied and got bigger or made additional profits. Is there anything you'd like to add to that, Apollo?
You got it exactly right. I mean, that intuition is exactly spot on. The difference between stocks and bonds is they're productive assets, and we can somehow try to get a sense of where does their value come from. I kind of expect the company to make profits. As a bond, I expect interest payments, and I can compute, I can derive some sort of a value from that productive asset. If you buy a farm, you make wheat, and then you get that. If you rent an apartment, if you buy and rent an apartment, you get that. I think the issue with gold is that it's a non-productive asset. If you put it on the table, as you said, you come back 20 years later, it's going to be there. It hasn't done anything. So in that respect, how do you truly value what gold is worth? So, the reason that you might want to own gold is because you speculate that at some point somebody is willing to pay more. And I think the one other point that I would pick up on that is that the volatility. So what volatility means is like, how much does it move around the average? And it seems like it moves tremendously around the average. When people look at gold and saying it's a hedge against inflation, I think it's a little bit thinking of the days when the gold was tied to the currency. And that hasn't been the case for about 40, 50 years now.
Yeah.
And at the time, you're right, you can take a currency and they'd get gold for it, but that's no longer the case. So in that respect, it's a little bit of a disconnect, because that was back then. Today, it's no longer the case. And when you look at how much gold fluctuates in price, in value, relative to the inflation is a little bit like this. Gold is something like this. And there's no way that he can say it's a hedge against inflation, but it used to be. So I'll give you that. It used to be. And if people are afraid of people in the South normally are afraid about, what's going on, and perhaps the government is taking over, the financial system is going to collapse, and I should go buy some gold. And I always wanted to ask him, why? What are you going to do with it? If somebody comes and you have no power, no lines, no money, what's gold going to do? Are you going to take a bar and shave a few things to go buy water? Or, you're probably better off buying wheat and a big bucket of water rather than gold.
So Apollo, Ken French recently did a video trying to explain to investors why market timing is so difficult. And in that video, he made the analogy between the price spread in a sport betting environment versus the price of a security, or the price of the market, maybe in mass. Would you maybe try to put that in your own words to see if you can help our investors understand why the price of securities are so important? They're probably sick of me saying this. I've been saying it like 50 times today.
Right.
But I love the analogy of the sport bet. And if you could maybe give us your version of that, I think it might be helpful for everybody.
Yeah, and frankly, it's I don't know that I've heard the most recent iteration of the sports bet. The one that I remember was more along the lines that if you look at a sports bet, it's not who's going to win, but by how much. So just knowing who's going to win doesn't really afford you much of an advantage. You have to go, what's the spread there? And that becomes really hard, because even if you got it right, the team wins. Everybody knows that one team might be better than another, but just saying, I know they're going to win is not enough. I actually thought of the market timing more in a different perspective, because market timing normally means that people look and saying, I should be out of this the market and then come back later, or I should be out of the stock and come back later. So making all these movements. And I think, but particularly when they look at markets and being in and out, I actually think of a little bit differently. I think of it as something that people genuinely believe that getting out of the market and waiting for certain to return, whatever certainty means, is a better strategy than staying invested. And I have to say, years and years ago, when I was first getting started investing, I did try it, and there are some lessons that I learned. And the first big lesson that I learned is that if you think that the market right now is too high, there's uncertainty coming down, well, you certainly want to sell and then buy back at a lower level. Because if the market at 28,000 is too high, you say, I'm going to get out waiting for certain to return, then you don't want to buy, you don't want to sell at 28 and come back and buy at 30, because then at that point it'd be silly. You bought high and sold low, which is not what you should do.
You think it's mispriced. You really
exactly.
think it's mispriced.
It's mispriced. Again, as we talked about, mispricing means that I know more than everybody else in the world, that everybody gets it wrong. I mean, one of the questions, what if they always get it wrong? What if you're right and you go to your grave thinking that you're right, but nobody ever realizes that you were right? But the point is that, let's say now that you sold and you want to get back in. So the first decision you have to make is not only when to get out, but when do you get back in? And if people are telling you market's too high, well, what's the right level to get back in? Is it 27, 26, 25? What if it never gets there? In my case, I set a threshold that was so low that the market never got there. And at some point, the reason that I got back in the market, and I tell you what, this is something that I've seen it lately, is that the stress of being in the market was very quickly replaced by the stress of being out of the market. Because now I'm looking, the market's going up and I'm just still waiting to magic number to get back in. And that stress was actually harder to take because I inflicted this upon myself. Right. And that to me is the problem, is that if you don't know when to get back in, not only that you might miss the upside, but you're going to create a different type of stress. One or another, you're not going to eliminate the stress. I think you're better off going with what Mark has, which is a balanced portfolio that has some stocks, has some bonds, has large, small, international, emerging, and putting all of that is probably a better way to go.
I was just reflecting just before we wrap this up here. I really, really enjoyed looking at your differences in the indexes. We spend a lot of time trying to get clients to understand what is the right benchmark. And there's one additional observation I wanted to make. You don't have to put the slide back up, but I want to remind people that Nasdaq is really a stock exchange. We do call it an index, and in the early days when Eugene Fama and Ken French were sorting out stocks, they were looking at the New York Stock Exchange, and they're used to track the New York Stock Exchange in terms of those returns. What the people at Dimensional and in Eugene Fama and Ken French did that's so different is they looked at company characteristics that have some correlation to the returns that those characteristics have earned over very large sample sizes of time. And through that, they come to conclusions that there are what they call factors, which are really just the characteristics of the company. They're large, they're cheap, they're high relative to the book value, these kinds of things. And if you think about it, this is so much more intellectual, I just call it intelligent way to start dividing and what they call cross sections of returns, the dimensions of returns. If you move your head, that's where you come up with this name, dimensional. These are slices of the market, and dividing the market up in this manner instead of the Dow based on the price, the S&P versus on a committee of 8 that says this is based on an industry, and all of these other ways that we literally have forced on us by the financial media as return benchmarks, is not your best way to look at the markets. And this is why we like Dimensional, is they take a very scientific approach to this, and they carve up the market in research indexes. Go to Google Ken French's indexes, Kenneth French indexes, and you'll go to his website and you'll see a more intelligent way to divide up the market, to analyze the market, to benchmark the market, to invest in the market. And this is why we're fans of Dimensional. They don't pay us a penny. We go through this every time. That's why I was saying you're biased, and you say stick with Mark because Mark uses your funds. But listen, as just two guys here, we both came to this because we appreciated the work of these academics. Apollo took this job. I created this company around these ideas. And David Booth likes to say this is a company based on ideas that are actually bigger than our company. I love that. I would just say in general, almost all of these questions have to do with the fact that people are concerned that whatever their perceptions of information available in the market somehow has not been reflected in the price. And almost every time you should ask yourself after you ask the question, but is that information already in the price? And if it is, move on and spend your time and your thoughts on something more valuable. So
nothing to see here, folks. Move on.
Anyway, Apollo, amazing as always. I really appreciate you taking all this time with us. I know you're very busy. Apollo has done literally hundreds of these types of conferences, beginning back in COVID, about February 18, I think was the day that the market took the first little drop. And the whole Dimensional team, what's kind of interesting is they were developing a studio in Austin. Finally, I've been urging them to do this for years. They finally put together a nice studio and they finished it just before COVID hit. And so they were perfectly positioned to move right into this multimedia, web-based education. And I have to give kudos to all of the team at Dimensional for providing incredible education. And I have to also say, Apollo, your slides have really gotten better. I know for a long time your goal was to match IFA with your slides. I have to tell you, you're up in the ante a little bit. I'm going to have to work on slides a little more. Anyway,
it's fun.
It's always great to see you, Apollo.
Great to see you.
Great to see everybody today. And I look forward to a future event. We're going to try to do these with Paulo for future quarters if he's willing to come back on. It's
great fun.
Just 4 times a year, but it's a good time for us to touch base with him. So goodbye, everybody.
Have a great day.
Have a great day. Bye, Paulo.
Bye-bye.